If you've been watching the economy over the past year, you already know that 2024 and 2025 were wild. Inflation cooling, the Federal Reserve debating every move, markets reacting to every headline. And now, here we are in 2026, staring at one big question that affects every investor, every homeowner, every business owner, and honestly, every person with a bank account. What happens when interest rates finally come down? Today, we're breaking down how rate cuts will impact stocks, the housing market, and your money this year. Rate cuts are one of the most powerful forces in finance. When they happen, they create winners, losers, surprises, and opportunities that most people never see until it's too late. But before we get to the video, if you're new here, I'm Elliot. I make videos about investing, the stock market, and I share updates on my own Robinhood portfolio. If that sounds good to you, feel free to subscribe. I upload new videos every 2 weeks. Let's start with the big idea. When the Federal Reserve cuts interest rates, they are lowering the cost of money. Borrowing gets cheaper, spending becomes easier, companies can expand. Consumers start feeling confident again, and markets usually react before the rest of the world even notices what's happening. Whenever rate cuts happen, growth stocks historically get the biggest boost. Think tech innovation, AI software. These companies borrow to expand. They live in the future. So when money gets cheaper, their future earnings becomes more valuable right now. Suddenly, analysts start raising price targets, Wall Street gets excited, retail investors start asking, is this the next bull run? But it's not just tech. Small caps tend to come back from the dead during rate cut cycles. These are the companies that felt the pain quicker when borrowing costs shot up. But when rates fall, they often snap back with a kind of energy that catches people off guard. Dividend stocks tell a different story. When rates fall, the thrill of earning 5% on a high-yield savings account starts to fade. But the strongest dividend companies, especially the ones with pricing power, often perform extremely well once the market stabilizes. Steady, predictable, exactly what people look for when the world feels shaky. And we can't talk stocks without talking AI. This is the part where many viewers' eyes light up. AI companies, chip manufacturers, cloud infrastructure providers, they're in a multi-year growth cycle, and cheaper capital only accelerates that. Now, let's shift towards the part of rate cuts that often hits close to home for most people. Housing. Housing in 2026 is a complicated story. Some people think rate cuts will finally bring prices down. Others think it will send prices even higher. The truth sits somewhere in between. Lower mortgage rates instantly increase demand. Millions of people on the sidelines start wondering if now is their chance. But inventory in many cities is still tight. So instead of prices falling dramatically, what we typically see is a surge in competition, multiple offers coming back, and homes selling faster than before. But the big change is affordability. Even a 1% drop in mortgage rates can save a buyer hundreds of dollars a month. That's the difference between we can't do this and let's put in an offer. If you're a new homeowner, this is the part where things get interesting. Lower rates mean refinancing becomes an option again. Home equity grows, your home becomes a financial safety net instead of a stress point. Builders love rate cuts too. Lower borrowing costs means more construction, more projects, more hiring. Investors re-entering the market is another story worth mentioning. When money gets cheaper, investors feel stronger. They borrow more, buy more, and that affects the entire market. It's not good or bad on its own, it's just part of the system, but it matters. Now, let's talk about something people don't expect, how rate cuts affect your everyday money. High-yield savings accounts that were paying 4 or 5% during the high rate era, those tend to drop quickly once the Fed cuts rates. Suddenly, cash isn't earning like it used to, and that pushes people back towards the market, back towards investing. Historically, that flow of money is part of what starts bull markets. Debt gets cheaper too. Car loans, credit card APRs, business loans, student loans. But here's something people forget. Rate cuts affect how people feel about money. When rates fall, people feel hope. Confidence rises even before anything changes in their wallet. They start acting like things are improving. And when millions of people feel that way at once, the economy moves. So what does all this actually mean for your future? It means you shouldn't wait until the headlines say rate cuts are officially here. The real advantage comes from how you position yourself ahead of time. Growth stocks, small caps, real estate, cash alternatives. You don't have to time anything. You just have to prepare. Before we wrap up, let me say something from the heart. I know the last few years have been heavy. High inflation, high rates, high stress. Feeling like the system is moving faster than you can. Rate cuts won't fix everything, but they will give people breathing room again. And for many families, 2026 might finally be the year things turn around. So pay attention, plan ahead, and put your money where future you will be thankful. If you found this video helpful, make sure to give it a like and subscribe to the channel, and let me know in the comments below. How do you think rate cuts will affect stocks, housing, and your money in 2026? And we'll see you next time.